This lesson is going to show you all about the volume weighted average price indicator. So, what is it? The VWAP, as it's known, is used to calculate the average price of a coin considering the trading volume over a specific time period. So it looks like a moving average. The line in the middle, the blue line, is the VWAP. But it measures differently. It assigns more weight to trades with higher volumes. So a regular moving average focuses solely on the average price over a given time period, whereas the VWAP also includes the volume, making it potentially more powerful in certain instances. So, why do we use the VWAP? We use it so we can assess the average price levels of a coin, and then we can compare the current price to the VWAP and determine if price is trading above or below the average, which can help us make decisions. That's really all that any average price indicator tells us. MA, EMA, VWAP, all they're telling us is the coin above or below some type of average, and if so, we can then decide, is it too far above or below, aka overbought or oversold. So VWAP helps us with that by factoring in the volume as well as time. The volume weighted average price can be viewed on any time frame, but the most common is the session time frame, which takes it from the daily open to the daily close and is used for intraday trading. Very, very useful. You can also view it on other time frames, weekly, monthly, or even yearly. On the screen, you see a session volume profile. So this is 1 day worth of price action. It is set there as standard when you use TradingView. You can find it on TradingView here in the Technicals tab. Type in volume weighted average price, it will come up. It resets to 0 at the daily close. The blue line is the VWAP, and the green lines are plus and minus 1 standard deviation. We'll talk about standard deviation in a second. You can also get a yearly VWAP. You can find on TradingView by typing in yearly VWAP and looking for this particular guy. And that will show you a view of high time frame analysis. So this is a daily chart, and the yearly VWAP, you can see, shows a price bands for a higher time frame. It resets on the 1st of January every year. The first 3 months are unreliable. Look here, this is January. You notice that in the first 3 months there's barely any bands, there's barely anything to trade in because it's a new period. But after this, it provides useful confluence for higher time frame trend analysis, as you can see that later in the year, price respects the upper band, 1 standard deviation. Also, in the beginning of a new year, if you're using the yearly VWAP, you can look at the previous year's levels as they often get respected. This orange line was the middle line of the previous year, which ended on the 1st of January. But you can see if you draw a straight line across that when price first visited that level, it respected it. So you see in the markets, in Bitcoin in particular, VWAP is a respected indicator by many traders, and therefore it has some validity. So how can we use VWAP to trade? Let's talk about a practical strategy. Very simple one would be riding an uptrend or a downtrend. So you would monitor the price of a coin in relation to the VWAP. So you would have this bands, you would have them on, you would have the VWAP on your chart. If price is above the VWAP and it holds, you would consider longs only. Or if you're already in a long, you would remain in your existing long until the VWAP breaks to the downside. So in this example, you would remain long all the way through this session until here when it broke below the VWAP. At that point, you would consider closing your longs or entering into shorts, because if price holds below the VWAP, you can consider shorts and remain in your existing short trade until it breaks back to the upside. This strategy, very simple, allows you to ride the momentum indicated by the relationship between price and the VWAP. So by using the VWAP right, you can make better trading decisions and stay on the right side of a trend. Now, let's talk about standard deviation. So the VWAP is one line, a type of moving average. You see it here in the middle, marked as VWAP. But you can also use VWAP bands to measure deviations in price. The TradingView indicator allows you to measure up to 3 standard deviations depending on how you set it. So what is a standard deviation? Standard deviation is a way to measure how spread out or varied a set of numbers is. Think of a bell curve. The bell curve here, also known as a normal distribution. This is a pattern that represents the distribution of outcomes around an average value. So in our example, the average value is the VWAP. So the midpoint of the distribution is the VWAP. That is also viewed on the chart as your middle line. So in VWAP, the middle band represents the average, which is similar to the peak of the bell curve, and the upper and lower bands at 1 SD indicate a range that encompasses most price movements. You see here on the distribution, 68% of all price movements will fall within these two bands. That simply means that the market generally spends its time in between those bands and doesn't go beyond them. So just like the width of the bell curve, the bands tell you where price should be most of the time. When the price moves towards the two standard deviation bands, it indicates the price is overextended and might help us to suggest a high probability reversal or a shift in the trend. Similar to how the extreme values on the tails of a bell curve indicate less common occurrences. 95% of all outcomes fall within two standard deviations either side of a distribution. Meaning, when we look on the chart and make this practical, 95% of all trading should occur normally between the 2SD and the 2SD. So what does that tell you as a trader? We can then use a simple thing like VWAP bands with standard deviation to allow us to avoid bad trades, such as buying at 2SD or above. You know that 95% of the time, this will not go beyond 2SD. So why would you buy up there if you've only a 5% chance of winning? Similarly, in a big down move, you would not sell at -3 SD, right? So this opens up another trading strategy. It involves waiting for the extremes and then trading the opposite direction back to the VWAP level. That's known as fading. So in this instance, where it went up to the 2SD, you could have taken a short trade back to the VWAP, which was reached sometime later. That is a valid trading strategy. That can be the building blocks of a trading strategy that you can use. So, in summary, we can see how VWAP is useful both for trend continuation and for fading overextended moves. So now let's move on to the next lesson.